Here with our trades is CNBC contributor Courtney Garcia, senior wealth advisor with Payne Capital Management. Up first, Courtney, Match Group shares down 1% so far this year. Your trade on Match. Shall we strike a match?
We do, yes. I would be a buyer of Match here. I don't really think our online dating is going away anytime in the near future here. They have some really popular platforms, Tinder being their main one, which has really been the reason largely that the shares have been under pressure, as they had some increase of prices, which meant less users for Tinder. But now you're seeing growing revenue and popularity in Hinge, which is their second largest platform. And that's not just growing here in the US. They're actually starting to push into European markets, let alone when you look at Asia, that is a hugely untapped growth over there. When you just look at the demographics, there's just such an addressable market there that hasn't yet been tapped into. And I think that's really going to be their longer term growth story, is when you look not just here in the US, but abroad. And it trades an attractive valuation. Over the last 5 years, it's averaged about 28 times forward earnings. It's currently only trading about 12 times earnings. So I think for all those reasons, I would swipe right on Match.
There you go. Exactly. I was going to say that, but I can't remember if it's right or left or what the right way is. Anyways, up next, Courtney, let's talk about Caesars. Shares down 6% for the year, but the average price target suggests a nearly 37% rally. Of course, the sell-side analysts are correct. So what's your take on this one, Caesars?
I'd actually stay on the sidelines of Caesars. I do actually like a lot of the casino operators, but when you're looking at gaming demand, a lot of that is much more abroad than it is here in the US. So specifically Macau and Singapore is, I think, where a lot of that growth potential is going to be. And some of your other casino operators do have that exposures. Caesars doesn't. And they also did have a recent merger with El Dorado, which I think longer term is going to be a benefit for them. But what happened is they had to take on a lot of debt for that. So although they do have good operating margins, a majority of that is going just to pay off of interest payments, which is likely to continue to weigh on their shares for a little while here. So I would stay on the sidelines for those reasons. All
right, Courtney Garcia, let's go to the last one of the day, and that is UnitedHealth, UNH.
UnitedHealth, I would be a buyer on here. This also has been under pressure this year, like the other three. Most recently, they did have that cyber attack, which put pressure not only on them, but the entire healthcare sector, which hopefully they're starting to get under wraps here. And I don't want to discount the fact that that is going to be a short-term issue here, because we have no idea how that's going to affect their margins here in 2024. They've already had to pay out, I think, over $3 billion to service providers who were affected. But longer term and bigger picture, they are the biggest Medicare Advantage provider. And as you're looking at demographics here in the United States, you have over 10,000 baby boomers every day hitting age 65. That is going to continue to benefit them. And their shares traded about 17 times forward earnings, which is still lower than their historical averages. So for all those reasons, I would hang in here for the long term.